This is going to be about Chapter 6, Consumer Credit, and I would imagine that many of you already have a credit card, and some of you are against credit cards and only have maybe debit cards, and most financial planners would say it would be great to have at least one credit card so that you can build your credit score, and we'll talk about that in this chapter. So there's your learning objectives. Hopefully you have your Chapter 6 outline in front of you. So what is credit? Most of you know that credit is a way for us to get things now because we don't have necessarily the money right now, and we're going to pay for them in the future. We're going to talk about consumer credit. So consumer credit is mostly like short-term credit. So notice here it says except a home mortgage. So whenever we talk about debt, when we do some of the debt ratios, we're not going to include the house payments or mortgage payments. So they're only talking about kind of your, like usually 5 years or less. So like a car could be in that. So ways that we can finance purchases. Finance means to be able to kind of pay for them, if you will. Take it out of our savings, of course, use our present earnings, whatever we're making right at the moment, or borrow against expected future income, and that's really what kind of credit is. Some of the trade-offs is that we're potentially going to deplete emergency funds. That's one of the things you really should try to avoid. Always try to have 3 to 6 months of funds, of expenses, I should say, and an emergency fund. So spending current income on your luxuries will eventually reduce your future well-being. It simply means that if you spend a lot of money now, then it's going to hurt in the future because you have to pay for it in the future. And that's what those bullet points are saying. So you should always ask yourself this before you're making a major purchase. Just a series of questions right here. I'm just going to give you a minute to kind of look through them. And I know you want to go down there and fill in your blanks. So, can I postpone this purchase? Do you really need it? I just bought a new car, a used car. It's 3 years old, which to me, that's kind of the sweet spot. We'll talk about cars later. But anyway, it's like 10 years old. And of course, I've had it for about 6 or 7. And I've been postponing it for quite a while. It would break down. I had some mice that lived in it for a while, and they ate my wire to my gas gauge, so I didn't have a gas gauge for a long time. We couldn't find where they ate into the wire. I did find there's sunflower seeds under my back seats, though. But anyway, the point is, my wife really wanted me to get a new car, and she was worried because there was times where it'd kind of break down, and she never wanted to drive it because of that. I'm like, look, it still works for the most part. I'm not worried about it. So anyway, finally broke down and got a new car. What are the opportunity costs for postponing this purchase? So what's going to happen if you don't get it? Is it going to be a big deal? For me, one of the benefits of being able to postpone my car purchase is that each year I wait, the technology gets better, the safety features get better, and so on. What are the dollar and psychological costs of using credit for this purchase? Psychologically, what's it going to do if you don't get it, or if you do get it? Is it going to cause you a lot of stress if you go into debt? That's another factor you have to consider, because now I didn't have any car payments, and now I have car payments. So I don't like that, but it is what it is. So some of the advantages of credit. So the biggest thing is you get immediate access. You get to buy it right now. You want something and you got a credit card. You may not have the money, but you're like, okay, I'll worry about it in the future. It's also good in case of financial emergencies, whatever that may be. Health-related, car-related, rent-related, whatever. So that can help out quite a bit. And it's easier to return merchandise a lot of times. So one thing I love about going to Lowe's is I never keep my receipts, but I always use my same credit card. And if I ever need to return anything, I just give them my credit card and they can find my record that way and credit my credit card for that amount. So that makes it so much easier. So how is it safer than cash? So I have in my wallet, I have say $20 and I have my credit card. And if I lose my wallet, which I have done, I go onto my phone or my computer and when I lost my wallet, I just froze my credit card so no one could use it. But if someone finds my wallet, my $20, it can easily be gone. So whatever cash in there can easily be stolen, but they can't necessarily use your credit card. And even if they do, you're not going to be charged for it. And so a lot of times when you want to make a reservation for a hotel or a car rental, you need to have a credit card to be able to kind of guarantee that. And some credit cards, and my credit cards have done that. I just haven't really used that. I have used a credit card one time. I was in Canada and I rented a car. Sorry, as I was saying, I rented a car in Canada, and I had a rock hit my windshield, and it was debatable as to how much it was going to cost my insurance company, but fortunately my Visa card covered my car insurance on the rental and paid for that windshield. So there are definitely benefits beyond just being able to get money quickly when using credit cards. Biggest disadvantage, research shows we tend to spend like 12 to 18% more when we use a credit card versus cash. And I know we're pretty much in a cashless society nowadays, but anyway, it just means that when you don't see the money physically like leaving your wallet, we tend to maybe spend a little bit more than we want. So if we don't pay, failure to pay, we could lose our good reputation, credit score, and so on. So this, I wouldn't necessarily call this a disadvantage, but it does not increase total purchasing power. So in the sense that, yes, I can buy a car now even though I don't have enough money in the bank. So you can say, well, that's increasing your purchasing power. It isn't and isn't. It's just shifting time. I still have to pay for it. So my purchase is still there. My cash outflow eventually gets there. It doesn't mean I have a lot more money per se. I have to eventually pay it off. And credit costs money. Simply interest. You've got to pay interest on it. So just a few different types of credit. So closed end simply means it's like a single loan. So like you buy a car, a house, something. It's for a specific purpose, specific amount of time, and a specific period of time. Specific amount. So you're buying it for a car for $20,000 for 5 years. Okay? And these are typical situations. So we call it closed end. So closed end, there are some examples right there. Opened end would be like your credit card, meaning you kind of keep using it. It's like a revolving line of money for you. So open end is like a line of credit. Credit cards are issued by, you can get them by department stores or bank credit cards. And keep in mind that you don't have to get a credit card from your bank. You can get it from, go on the internet and search for, credit card deals. Always try to find one, in my opinion, for no annual fee and some money back. About the best you're going to find is 2% back on all purchases with no annual fee. Okay. So about 70% of American households have credit cards, and about half are convenience users and pay balances full each month. This is something, top 10 piece of advice. try to pay your credit card every month. And some people say, well, is that going to help build my balance if I pay it off? Because they're thinking that if they make payments, it's going to help build their credit. No. Pay it off and don't pay any interest, and your credit score will continue to go up. So I mentioned earlier that some of you have debit cards, where this is debit, meaning it just simply comes right out of your checking account or savings account, however you have it set up, and you don't get credit per se. You don't have any extra money from somebody else that's given to you. Home equity loans. So if, let's say you bought a house, or let's say you own a house for $100,000, and you have a $20,000 loan on it, or what we call a mortgage. Loan, mortgage, same thing. Okay? That means you have $80,000 in equity, because if you sell your house for $100,000, you only owe $20,000, so you have $80,000 that could be used for a home equity loan. So you can borrow up to 85% of the appraised value of the home, less the amount still owed. Okay, so I'm not going to do the math here, but anyway, the point is you could borrow to like 85% of that and use it as a revolving line of credit. The good thing is the interest on this is tax deductible, meaning you can put that on your income taxes and say, I paid this much interest, and that would reduce how much taxes you owe. Your credit card interest is not tax deductible. So in terms of how much credit you can have, you got to ask yourself, well, can you afford the loan? Can you make all the payments? Ask yourself, what do you plan to give up in order to make the monthly payment? Are you prepared to make this trade-off? So for example, I've just got a car, I got to figure out, okay, so my payments are like $500 a month. Can I handle that? Am I going to have to give up something to be able to afford to get that car? Pretty straightforward. Okay, so I don't have this exact information on your handout. I left that off. I have just an example. So on your page you have an example, so you might want to write this off to the side. It's pretty straightforward. So it's what we call the debt payments to income ratio. So the key thing to remember it's pretty simple. Take your monthly debt payments divided by your monthly income. But don't include your house payment. I mentioned that earlier because it's what we call a long-term liability. So it's kind of a strange wording of this question. So monthly debt payments excluding house payments. Okay? And so kind of each, the banks have different amounts, the credit card companies have different ratios in terms of like what you should be able to handle. But in general, consumer credit premiums should not exceed a max of 20% of your net income. So if you're making $1,000 a month, you shouldn't have any more than $200 that are going to credit cards and other car payments and so on. Hopefully you'll be making more than $2,000. You guys will probably be making like $5,000 a month, so $1,000 in those other payments. And there's just an example of how you would do it. That's on your handout, so I'm not going to go over that. So the debt to equity ratio, so you've had this in Finance 3000 and other classes. We would take total liabilities, okay? And once again, I know it says total, and this is where it's a little bit misleading, but do not include your mortgage on that. So they're just basically, because that's typically the only like long-term liability you would have. So everything else on your personal balance sheet would be kind of like less than 5 years or less, and they would say, okay, that can be your total liabilities. When we compare that to net worth, it should be less than 1. You should try not to have more debt than what your equity is, at least prior to your mortgage. Okay, changing gears a little bit. Co-signing a loan. So most of you at your age will not be co-signing a loan. You'll be asking maybe your parents to co-sign a loan. Okay? But some point in life, you hopefully would be in that financial position where you could afford to co-sign a loan for somebody. Might be your own kid someday or a relative or whatever. But I want to warn you, it's probably not the best thing to do. And so here are some things to consider. So when you co-sign, you're being asked to guarantee the debt. So consider if you can afford it if the borrower defaults, which means they can't pay it back. That's what default means. So if the borrower does not pay, you may have to pay it like the whole amount and everything. And this is rare, but if a payment is missed, the creditor can collect that with you without first trying to get it from the borrower. So I've never heard of that happen. That's what this author says, but I guess that's possible since you both are equally liable for it. Some studies show that 3 out of 4, 75% of the cosigners are asked to wholly or partially pay back part of the loan. So that's why I would strongly advise against it. It can cause a lot of family issues, and if you have to end up paying for it, so just not a good idea. So if you do co-sign, can you afford to pay the loan? If not, your credit score is going to be damaged. Okay? If you pledge property, you could lose it. And if you're going to do this, make sure that any notices about overdue payments get also sent to you, so you know immediately what's going on, so that your credit scores are not damaged. So speaking about credit rating, because this is probably the most important part of the entire chapter, and really one of the most important points of the entire semester, in my opinion, credit rating. Because building and maintaining your credit score, okay, is extremely important, because, and I think I've said this earlier, that it's not just about getting a lower interest rate on a loan, or even for the matter of getting a loan. It's your landlord might check to see if you can rent from them. Your employer might check to see how responsible you are. Your insurance might check to see what kind of insurance rates to give. So credit rating can impact a lot more than just your financial life. Okay, so it should be nurtured and protected. You should check to see what's in your credit report, and you can do this 3 times a year. And we'll talk about this later, but you go to annual credit report.com, and that's the only place, no other place. That's a government website, so make sure you don't type it a little bit differently, but you can go there. I would recommend you go there right now and check it, and it's not going to give you a credit score, it's going to give you a credit report, not score. We'll talk about score in a minute. There's a lot of places you can get a credit score, and some of you may already be getting it on your credit card statement. Okay? So the credit bureaus are the ones that help kind of monitor what's going on. These are the 3 big credit bureaus, and that's why 3 times a year you are allowed to get your credit rating. It's like your credit report, because each time you get it from one of the different 3 organizations, and you can do it for free 3 times a year if you want. And the main thing is to make sure that they have accurate records about your credit report. And I had a student who I still keep in contact with, who graduated a few years ago, and she said she's really glad that I shared that. She didn't know about it, and she went on there and she found an error, and she's in the process, she's told me recently, of trying to get it fixed, because her credit score was impacted negatively. So the Fair Credit Reporting Act, this act regulates credit reports. It just means that consumers have the right to erroneous data, have it corrected. You would think that's just natural. But adverse data can be reported for 7 years, and personal bankruptcy for 10 years. Okay? So adverse data meaning you've done bad things with your credit. Bankruptcy, not good, 10 years. So what if you are credit denied? So on your outline, I don't have this chart. I just kind of typed some of these items on your outline. So you can just, where it says check your credit file at the credit bureau, then just kind of give you some of the steps to go through if you think there are some errors on your report. So when you go to get a loan, let's say from a bank, and it could be for a house, I know we're talking for other things, the banks will, and they can even do this somewhat for businesses, but they're going to look for what they call the 5 C's of credit. So here's, of course, all your blanks. Character. Do you pay your bill on time? Capacity. Can you repay the loan? Capital. What is your net worth? Collateral. What property do you have? So for example, character. You may be asked, like, how long do you live at have you lived at your current address? Do you own your own home? How long have you been employed? And they're trying to get a sense of, like, are you moving around a lot, not real stable, and so on. Capacity, can you repay the loan? So, what's your income? What are your expenses? Capital, net worth, simply looking at your balance sheet, assets minus liabilities. Collateral, what kind of car are you buying? And then conditions, are we in COVID situation where everybody's getting laid off in your industry, and so that wouldn't be really good. Okay, so those are some of the things like credit agency would look for. Now, your FICO or your Vantage score. FICO is probably the most popular. FICO stands for some like Fair Isaac. I should know it. So I just Googled it. Fair Isaac and Company. CO stands for company. Whatever that means, it doesn't matter. Everybody just refers to it as your FICO score. And that's on a scale of 300 to 850. 850 is like perfect. And I hate the score, and I think it's the most ridiculous kind of continuum. Who grades on a 300 to 850? And I have asked numerous people, and no one seems to know the answer. And it drives me nuts when my bank calls me and says, okay, we have a client, because sometimes I have to like approve loans. We've got a client that has a 723 score. I think, what's 723? Is that good or bad? So why can't we have the scale on like 1,000 or 100? Just make it 100, just like, anyway, I'm sorry, I'm just rambling. Anyway, so the higher the number, the better, and I'll show you kind of the breakdown of kind of what's good. There you go. So 800 to 850, exceptional. 21% of Americans are there. 740 to 799, 25% are there. There's good. So I know these numbers really don't mean a lot to you, so unless you have your credit score. So some of you already know your credit score, and you get that on maybe your credit card statement. There's fair, and then very poor down to 300. So about 2/3 of Americans have a good FICO score. So what determines your score? The biggest, and this is important to note, the biggest is your payment history. It's right there. Payment 35% payment history, and then amount of money that you owed is like 30%. Those are more than half. The biggest thing is your payment history. Make sure you make your payments on everything on time. On time. Okay? So how can you improve your credit score? Get copies of your credit report, which I just told you about. Go to annualcreditreport.com. It's free. Now, if you've never had a credit card or any kind of credit, it'll just come back and say you have an error. You will have to put in your social security number, but it should be safe as far as I know. They've been doing it for years and years and years. It's a government website. Okay? The main thing is to review it for accuracy, just to make sure there's no one out there that's using your identity is the big reason to do it, and just make sure there's no black marks against your score. Okay? I looked this up and I thought it was kind of interesting. Average credit score by state. So the darker you are, the better. Okay, the better. So it's interesting that this region up here in our country is much better than the South. The North is better than the South in terms of credit scores. So one other benefit of having a credit card or paying with a credit card is that if for some reason the service or good that you got was not up to standards, your standards, or it's just broken, doesn't work, or whatever, you can ask to withhold payment from that company, and then Visa will look into it. I've done this very rarely. I did it once or twice. And you can just easily go into your account online and just say, I want to dispute this charge, and then Visa will ask you a few questions regarding it, and what you've done to resolve it, and then they'll contact the merchant and they'll try to work it out in whatever they deem to make the most sense to both, kind of be the judge of what happened. The last thing is identity crisis, and you've probably heard a lot of this, especially the last 10 years, people stealing others' identity. So, if your identity gets stolen, you just need to contact the credit bureaus and let them know what happened, so that in case another credit card is tried to open up in your name, it gets flagged and they contact you. They say they want to make sure, is this right? Is this you that's actually doing it? You could file a police report depending on really how bad it was, to show them that it's pretty legit. Close your bank accounts immediately, and then you can also contact this clearinghouse and let them know what's going on. Okay? And that is chapter 6.